Welcome everyone and welcome back to our channel. Today we're diving into the topic that affects all of us thinking about home ownership, which is mortgage interest rates. And they've been crazy lately. They're always crazy, but it's just kind of determining how these rates are made up so it'll help you in your journey for that home ownership piece, right? It's critical because it has a significant impact on your monthly payments and your overall financial planning. A lot of people are like, well, I'm gonna wait till rates drop, or I'm gonna wait till a certain period of time. But right now, what we've seen over the last 2 years of rates have just been very volatile, right? They climbed up extremely fast from the, we did low interest rates as low as 1.99%. And sometimes they're hovering up to 8.5%. So really, how do you determine these rates and stay informed enough to be able to be on top of it to kind of see those trends, right? Mortgage interest rates, right, represent the cost of borrowing money to purchase a property, right? That determines the amount of interest you pay on a monthly basis. So the higher your loan amount is, the more interest you're paying back. And if you ever look at like the repayment cost on a loan, it gets kind of crazy, especially when you look at the lifespan of a repayment. Now, there's definitely things to consider around that. One of them is that, and talk with a CPA about this, is but you can write off interest on your mortgage. And on average, people stay in their home about 7 years. So you really never go through that entire length of time. But there's definitely caps on certain things when it comes to your taxes. So again, talk with your CPA or accountant, okay? Next part's going to be that principal balance, right? So the interest rate on that principal balance when you initially purchase the property is going to be at its highest point, right? Because we don't do negative AM loans anymore where you can actually go negative on your balance. It's going to get reduced on a monthly basis. And that's how interest is actually calculated. This is why it's a really good idea to make extra payments towards your mortgage, because it reduces the principal balance on a monthly basis. And then the loan is re-amortized, is what we call it, is because let's say you had a $100,000 mortgage, you made a $1,000 principal payment on that. Now the mortgage is calculated at $99,000, not like $99,900, as it probably would if you're making your first payment, because it's going to be mostly interest that you're going to be paying. This is why people have different strategies for paying off their mortgage faster, because it also is a way to be able to save hundreds of thousands of dollars in interest. It's no BS. It's very real. So let's talk about the Federal Reserve's piece to interest rates, because that's something that is always a hot topic, all right? So the Federal Reserve, or the Fed, is the central bank of the United States, which influences the economy's liquidity and interest rates, right? While the Fed doesn't set interest rates directly, its policies on short-term interest rates affects the broader financial environment, which includes interest rates, okay? When the Fed adjusts its target rate, right, for the federal funds rate, which is the rate that banks borrow from each other overnight, it influences lending rates across the country, including mortgage rates. Lowering the Fed's funds rate can lead to lower mortgage rates, but the opposite can happen as well. So this is why all of this is going to be a big factor. So let's talk about some of the factors that influence the rates as well. Another big one is going to be inflation, because that erodes purchasing power. We've definitely seen a lot of that lately. Which lenders account for by charging higher interest rates to maintain profitability. As inflation increases, lenders typically raise interest rates to protect themselves, affecting interest rates. So that's why a lot of times you kind of see either big dips or big increases in rates right around the time the Fed is also making those announcements about inflation. If it's not changing it, if it's increasing it, or they're going to decrease it, mortgage rates are already being affected by that before you even go into that. I don't know, they maybe have a glass ball that they can see what's happening with the markets. Another factor with that is going to be actually unemployment rates. That's why when you see the unemployment rates get published, the markets also get really crazy. So what you're trying to stay away from is negative news around that, because it has a big impact. And actually, sometimes negative news actually is really good, because when the economy does bad, they want to stimulate it, so they lower interest rates. So it's kind of people want things to be really good, but then really, like, how does it affect you from a mortgage side, right? So one of those things is unemployment, right? So high unemployment rates signal economic distress, right? So leading to lower interest rates as the Fed aims to stimulate the economy. But then the opposite happens when there's low unemployment rate and everybody wants to be purchasing a property because they're employed. Then mortgages are in high demand, rates are going to go up. Another big component to it's going to be the gross domestic product, also known as the GDP, which measures the economy's total output, right? So a strong growing GDP often leads to higher interest rates as demand for homes increased in a robust economy. And on the opposite, a weak GDP can prompt lower rates to encourage borrowing and investment. So that's why all these things kind of play together. So let's talk about it from the lender side, because I think this one is pretty interesting, because I always talk about this. But definitely lenders consider a variety of factors when setting the rates, right? So this includes the cost of obtaining funds, right? So how much money does it cost to get money, right? Because then that's how much they're paying. Now they have to build their margins in, which are going to affect their operational cost and the competitive landscape as a whole, right? They also assess the risk of lending to an individual borrower with lower rates for those deemed less risky. We're always talking about that, but we're going to cover that a little bit more in a second. But let me talk about operational costs. So if you're working with a lender that they're advertising on TV across all social media platforms and hiring high-paying actors for their commercials, which, by the way, are great. But who do you think pays for all of that? And it's going to be you. I can't stress that enough. The banks that we always think are going to be your biggest lender-friendly banks take the biggest advantage of veterans, like by a crazy margin, because it's expensive to run a mortgage company, especially if you want to have good people and you have high operational costs. Like, you have to pay those people salaries, right? And so just be really careful with that. You really shouldn't be paying that much to get a mortgage. If you guys have questions or want to get connected, you can schedule a call with me in the description down below. So I'd say one of the biggest factors for your interest rate is going to be your credit score. It's probably the most important part, because the higher your credit, the better interest rate that you're getting, because it shows to financial institutions that you have the least amount of risk. On the opposite side, if you have bad credit, typically you have late collections, which signals that it's a much riskier loan to take on from a lending side. And it's also the chances of you repaying that loan based on your credit score are going to be less than a higher interest rate person. That's why you have banks competing for the top tier of buyers out there, because it's the best chances of your loan being repaid when you make it. So why wouldn't people do it? Another factor is going to be your loan to value ratio. This is based on how much money you put down. Now with VA loans, it doesn't really affect it that much, but on conventional loans, it has definitely a big factor. So the more money you put down, the better interest rates you get, unless you qualify for some of those possible home ready programs, which, then it's a little bit different story. Then you actually can get better rates with worse credit. I'm not really sure how that works, but that's the way it does. And also the type of property you purchase also has an effect. So if you buy a multifamily, a condo, or a single family, they're all going to have different rate. They're all going to have different interest rates, which is also another factor of that. Now let's talk about market conditions, because that's kind of what we see also a lot of right now, along with the Fed and also what mortgage companies are doing. Supply and demand, right? So if you have little supply, high demand, you're going to have higher prices, right? So that's kind of what we see right now. Do we think there's going to be a buyer's market anytime soon? No. No, I really don't see it because you have so many people that locked into those low interest rates. So even if they don't like homes, we talk to people all the time. They may not like their homes, but they're staying in them because if they move and buy a property that's the exact same price point, which they can't, normally it's going to be about double the price. So even if they find a home that was the exact same value of their property, their interest rate, their mortgage payment would be twice as high. And so that's why people aren't moving in that. The other part is going to be the bond market. Basically, the mortgage companies look at the 10-year treasury note. So that's why we're looking at that daily, right? So if we're seeing that go up, we're like, all right, rates are going to be going up. If we see that going down, then we're going to know that, hey, rates are going to be going down and we're going to be holding off on locking loans. And there's also the global economy that has a factor in all of this as well. So it's like rates could be trending down and all of a sudden they have this global event that happens and now all of a sudden rates go up and it comes out of nowhere. It's important that you understand, at least have a baseline for how these things work, because I think sometimes, people that, let's say in a couple months ago in December when rates really were low, and this is for educational purposes, right? I'm not, everyone's financial picture is different. But back in December, you can get a 5.75 all day long. Today, right, you're getting around 7.25 without any discount points or like origination fees. That's like a whole separate video we're gonna do here shortly. But all those things are gonna be factored into your decision. But again, if you guys have questions, schedule a call with us. Make sure you hit the like and subscribe button. We'll catch you soon.